Welcome to the NGEN Markets Training session and good evening, everyone. Meanwhile, others are joining in. We will discuss about our topic for today. So today we are going to be analyzing risk parameters for mutual funds, and we are going to be taking a look towards different sets of parameters like value at risk, which includes the historical and implied. And we are also going to be comparing what is the difference between the historical and implied. Then we will take a look towards the capture ratios, rolling returns analysis, volatility analysis, and then to top it off, we will be completing our session with the drawdowns analysis. And if you have any questions, we can then have a Q&A session. So I will be opening up the forum for everybody. So anybody, if you have any questions, you can write it on the chat box or verbally, and I will try to address them. So that's it for the today's topic. I will just head over to the engine terminal here so that we can then start our session. And I hope my screen is visible to everybody. If not, please let me know in the chat box and I will try to address them. So specifically now, as you can see, this is an engine markets terminal. And if you want to analyze any mutual funds, there are several ways. So I'm just going to be showing you the basics of actually onloading an analytics for the mutual fund. One way is to directly take a look towards the fund section and you can click on the fund and the fund actually opens up in one single tab. So this is another one way. Another way is to actually search that particular set of a fund. So let's say we are searching a random fund here. And once we search it up, you can then load the analytics itself in the engine terminal. And here what you can see is the analytics for the entire set of a mutual fund, where you can, whereas you can analyze them based on the fund performance till the different sets of tabs like rolling analysis and the beta analysis. Now here what you can effectively do is you can effectively run in multiple tabs here. So if you want to run multiple tabs, you can effectively click on multiple funds. And as you can see, the balance advantage fund is on loaded. I can also load in another one. You can now see there are two funds here, which you can toggle around with the two funds and check out all the data sets here. So this is the basics of loading any particular set of the mutual fund analytics. Another way is to once you load in the mutual fund. So let's say we are loading in the fund again, and let's take a look towards our value at risk parameter. So for the value at risk parameter, it's a parameter which is used to understand the probability of the loss. So basically, you can towards value at risk here in the fund performances, and here we have given the historical VAR, which is called as value at risk, and the implied VAR. Now let's take an understanding of this, that how it works and how do we calculate value at risk and what is the significance between both of them and how you can use this parameter to effectively analyze mutual funds and even the portfolio analytics. So for an example, what we are going to be doing is we are going to be downloading the price series here. So first I'll just give you an overview here that what value at risk actually displays in our analytics. So let's say we are considering the historical 95% value at risk. Now, 95% is basically a confidence interval, and the probability which is generated is 100 minus 95, which is a 5% probability. So for a 5% probability, you would have a loss of negative 23.01% based on the historical return sets. Now I'm going to be showing you how historical return sets are being calculated and how you can also take a look towards the implied value at risk and what is the difference between the two. But the main basics of this two value at risk is to actually take a look towards the probability, which is the 5% probability against the confidence interval, which we are considering 95%. And what is the loss we are actually backtesting here is negative 23.01% compared to the benchmark, which is negative 27.72. So at Engine, what we are doing is we are daily calculating the datasets and comparing our asset, which is our mutual fund, versus the benchmark, which is currently mid-cap 150 given here. So you can effectively change the benchmark if you want, and the value at risk effectively will be calculated based on that particular set of the benchmark. Now let's take a look towards the calculation of value at risk and the basics of it. I'm not going to be going too much technical on this, but I will just give you an overview how it gets calculated, and then you can effectively compare the two and use it accordingly based on your preferences. Now let's take a look towards the prices here. So the prices, what you can do is to get any data sets of a mutual fund or even a portfolio, we have given an option to download the prices. Now these prices gets downloaded in an Excel format, which is a CSV format here. And you see that these are the dates, price of that particular set of a mutual fund and the return sets. Now these depends upon the start date you have chosen. So currently the start date of our mutual fund was 1st October 2014. and this is the price, which is an NAV, and this is the return sets. Now, how do we calculate value at risk? So I hope my Excel is visible. If not, please let me know in the chat box. So currently what you can see here is the specific data sets, the return sets which are already being calculated by engine. So I'm not going to calculate it again, but what you can do is you can now calculate the historical and an implied value at risk. Now let's take a fact that we are going to be calculating based on the confidence interval, right? So for the confidence interval, what you can do is you can effectively take a look towards the confidence interval. So I'm just going to type in the confidence interval here itself, so that you can then analyze it accordingly. So let's say our confidence interval is 95%, which we have considered in at engine as well. Now, the probability here which gets generated is basically the difference between 100 minus 95, which will give you the confidence, which will give you the probability of 5%. So I'm just gonna, uh, I'm just gonna, subtract this probability here from the system itself. And then what you can do is you can effectively see that our probability is 5%, right? Now, the point here is that once you have gotten a hold on probability, now we can start calculating the historical and the implied value at risk. So for historical var, so I'm just going to show you how it gets calculated. What we do is we take a percentile of the daily return sets. So daily return sets are these which I've highlighted in green, and then we actually analyze those data sets and give you the results, which is -25 or -26 or something else, right? So what you can do is you can effectively take a look towards the percentile here. So percentile is the system here, and the array which we are going to be taking a look towards are these data sets. And then we are going to be using our probability. Now here what you can see is our probability is 5%. So I'm just going to be choosing this probability as 5%. And once you choose this probability, you can now see that this is the data set which is being generated, right? Now, what is the actual historical value at risk we should actually have? So we need to analyze these data sets. So to analyze it, this specifically, we are going to be multiplying this data set which we have currently generated with the square root of 260. So at engine, this is how we calculate the value at risk. And once I take a look towards this, so 260 is a working period in a year, and this is what the data sets is being generated. So let's compare the data sets here itself. I'm just going to show you the data sets here. 1 second. And this is what the data sets hold. So 1 second. Yeah. So this is the value at risk parameter which we have, and you can now see the data sets here. So I will just load in the fund itself here. Um, just a second. Yeah. Yes. So when you see here in the data sets format, we have the value at risk, which is given here as 23.01 with a 95% confidence interval. And when you see our Excel, our confidence interval is -23.01. So this is how the historical value at risk is being calculated. So I'm just going to be repeating it again, so that we can then take a look towards the implied value at risk. The historical value at risk considers the daily return set. This is the daily return set of any particular set of an asset in our system, right? And for the implied, what we do is we just calculate the standard deviation, and then we do the calculation for the implied. So implied is also considering the confidence interval here. So I'm just going to type in implied var here, which is I var. Now for I var, what we do is we take a look towards the standard deviation of the daily return sets. So standard deviation is given here. We take the standard deviation, a simple standard deviation will work out. And once it is done, then we multiply that standard deviation, as you can see here in the Excel, with the normalize of the inverse of the function. So which is called as norms inverse. What we do is that function returns the inverse of the standard normal cumulative distribution. Now this gets fairly technical, but what you can do is you can just multiply this and then use this data sets accordingly into the system, right? And once you use it, the probability here we are considering is 5%, as I've taken into consideration. And then you will get these data sets. And what you need to do is you need to just multiply the data sets with the square root of 260, right? So the square root of 260 here will be considered here as itself. So I'm just going to multiply these data sets. And this is what the square root of 260 looks like, right? So the point is that 1 second. Yeah. So here you can see that we have negative 24.59, which is accordingly 60. And that is how the calculation for the implied and historical and the implied value at risk works out, right? So here, I'm just gonna change the confidence interval and talk about the confidence interval here as well to break down the entire value at risk parameter so that you will get a clear understanding that why we should be using this particular set of the, value at risk parameter itself. So let's take a look towards the confidence interval, and then we will be talking about why this confidence interval and why we are choosing the confidence interval of 95% or 99%. So in a standard industry format, the confidence interval is preset to 95, right? So what we do is there is a 5% chance to have such a loss. So I'm just going to highlight these two laws for you for this particular set of a fund, which is called an Axis mid cap fund, right? So if I change the confidence interval here, let's say I change it to 99, you can now see the confidence interval is now changed, right? So the point here is that it just shows that there is a 1% chance, which I'm highlighting here, that this is the 1% chance we have to have such a loss. The 1% chance to have this kind of a loss is what we are trying to achieve here, to understand that what is the loss which we can handle out. So for an example, if there is a client which we have and is definitely looking towards a fund, let's say a mid cap fund, what kind of a loss a client can actually handle out, and this is where you can take a look towards the confidence interval and generate the probabilistic view of it. So in at Engine, what we have done is that once you consider a 1% loss, I'll just show you the percentage here, that for a 1% loss, which you would like to know, is all you need to do is just make it 99. So once you make it 99 in our system, you can now see that it's negative 43.70 compared with the benchmark, which is negative 54.16. So on the basis of historical daily return set, our entire asset is actually lesser riskier on the downside parameter. Similarly, for the implied, which is all on the basis of the standard deviation, on the basis of that, we are actually lesser riskier as well. So this is just the two methodologies of calculating the value at risk. The implications for both are similar. All you try to imply here is what kind of a risk the particular set of an asset can have against a benchmark, which can be more riskier or lesser riskier as well, right? So that is how it works out for the value at risk parameter. So I'm just going to be showing the Excel again to give you a proper understanding here. Value at risk considers two different parameters. There are several sets of value at risk in the industry. There's a conditional, there's a bootstrapping way to calculate the value at risk. But the main purpose here is that we have given two sets of basic value at risk where you can calculate it and then take a look towards it accordingly into the system, right? So historical value at risk considers the daily return sets. This is the daily return sets, whereas the implied value at risk considers the standard deviation of the daily return sets, and it then inverses the normal distribution of the entire data sets given the probability. So probability here is considered as 1%, right? So you can change the probability. I can even change the probability by changing the confidence interval as, let's say, what is the 12% probability to have certain loss, right? So you can effectively change the probability just by changing the confidence interval. And that is where we have given at Engine that what you can do is you can change this confidence interval to determine the probability of a certain loss. So here the confidence interval is given here. So just a second, I'm just going to show the terminal itself, and you can change the confidence interval one by one. So here what you can do is you can effectively make it, let's say, 90%, right? And the confidence interval is 10, as 95%, we have a probability of 10% to have certain losses. Normally in industry, we consider it 5%. You can even go for 98 as a 2% confidence interval, and then you can compare it with the entire set of the data sets, right? So that is what it is, and that is the entire set of the value at risk which we have taken into consideration. Now, what is the use of this? What you can do is you can effectively use these particular set of parameters to map it against a benchmark, or you can even use it on a portfolio level. So on a portfolio level, we have also given this same set of analytics to consider the value at risk of a portfolio against a particular set of a benchmark, to understand that if we are actually having a higher probability of loss or not, right? So this is where it works out. And on a sense, normally what we do it is that we consider annual volatility as a risk parameter as well, but it does not show us the downside risk, and that is where the historical value at risk comes into handy to understand the risk of any particular set of an asset in our system. So that is where the historical value at risk works out. We also have another set of a ratio which is called a capture ratio. So I'm just going to be heading towards that particular set of a ratio. That ratio is basically up capture and down capture ratio. Now, in this case, when you see the capture ratios, we need to take a look towards our benchmark as well, because it actually maps in based on the benchmark. So all the data sets which you see, this up capture ratio, which is 76.56, we have a down capture ratio which is 75.01%. What it is implies? It implies that when you take a look towards against one particular set of a benchmark, within up capture ratio, when you click on this I button, you can now see the breakdown of the asset, which is our mutual fund versus the benchmark performance. Now, these return sets which you see are the sum of the monthly return sets of the asset, which is our mutual fund, whereas this benchmark return sets are the sum of the all the monthly return sets for the benchmark. And when you divide this up, like it's 49 divided by 64, you will get this particular set of a ratio. Now, the ratio which is actually lesser than 100 in the up markets is actually not deemed to be satisfactory, because it shows that our asset has not performed well when the benchmark was up. And you can now see that our benchmark has actually performed 64.31 when our asset was just performing 49.23. And you can also see on a breakdown level that, for an example, if you see on a September 2015 month, our benchmark was actually positive, whereas our asset, which is our mutual fund, was actually negative, right? So that is how you can take a look towards the comparison of the up capture ratio. So up capture ratio signifies the performance of our asset when the benchmark was up, right? And the down capture signifies the performance of our asset when the benchmark was down. So for an example, when you see the negative performances of the benchmark, then you can see the performance of our asset is actually better, because benchmark was backtesting negative 44, whereas our asset was actually backtesting negative 33.44. So that is actually a satisfactory result, because here you can see the down capture is actually lesser than 100. And a down capture lesser than 100 is more recognizable, because it helps us to determine that this particular set of a fund is actually having lesser losses when the benchmark is actually having the losses in that particular set of the months or the years, considering the fact that you're choosing a start date accurately. So the main point here is that this capture ratios, the value at risk, will all change if you change the start date. So if you change the start date, let's say we are changing it for the last 2 years. Now only 2 years will be considered in the value at risk itself. So let's say if you have a, let's say if you want to compare and see that what has been the risk for this particular set of the fund, considering for the fact that against the benchmark what we have performed. So one thing you can definitely take a look towards is the value at risk, to understand that there is still, a 1% chance to have a loss of negative 44 for our asset, compared to the benchmark, which is negative 47.79. 1% chance, because the confidence interval here I've changed is 99. I'm just going to zoom it up to for a better visibility. So you can now see that this is a 99% confidence interval. Similarly, for the capture ratios, you can now see that down capture is pretty, closer towards 100. Before, when we were comparing for the last 8 years, which was 2014, the down capture was actually 70% or something like that. But here in this case, the ratio here is closer to the benchmark. It means that we are not, our benchmark, when it has losses, our asset is also similarly having similar losses, right? That is where you can infer these data sets. But in the up capture, you can definitely see that we are not actually performing on par with the benchmark. And hence, we are having a negative alpha. Because on a monthly data set, when you see in the last 2 years, this particular set of a fund has not backtested well against the benchmark. It has not performed well against the benchmark. And that is where you can actually compare the performances here. Here you can effectively see that on the first month itself, in the April 2021, the benchmark had a monthly performance of 1.85, whereas us, we had only negative 0.70, right? So that is where you can see the return sets are also lesser than the benchmark, and hence the, capture ratios are backtesting in such a way. If you see a up capture ratio more than 100, it does mean that our asset has performed well in that particular set of a period against the benchmark. So that's how the up capture ratios and the down capture ratios helps us to further determine the risk against the benchmark, because we can now understand that the risk on the value at risk parameter, yes, we are definitely lesser riskier, but are we performing well when the benchmark goes up, when the benchmark has a bull run? Are we having a good set of a performance? There you can check from the up capture ratios and the down capture ratios itself to determine the behavior of our asset versus the benchmark. So these are the two parameters I was just talking about, because these two parameters will help you to determine for any asset, even on a portfolio level. I will show you on the portfolio level as well after this session. But on a fund performance level, you can check these two parameters to determine the risk of the assets. Now, talking about the risk, we can also take a look towards risk on a rolling basis, because rolling analysis helps us to also determine the volatility here. So I'm just going to be showing the rolling analysis here. So let's take a data sets, at least some of the data, let's say 2011, and within 2011, what you can see here is that the rolling analysis is now running from April 2011 till the current date for a 1 year period, 2 year period, and 3 year period. So as you remembered before, I was considering an annualized data set of 260 for any particular set of a value at risk parameter. So 260 here we consider as a 1 year, as a working year. And you can effectively do is you can effectively change this data set. So let's say if I want to compare the data sets of 1 year, 2 year, and 5 year. So for a 5 year, it will definitely be 260 multiplied by 5, which could be 1300, right? And once you run, you can now see the periods are being compared with the days. So 1 year is 260, the 2 year is 520, and a 3 year period is actually 1300. So for an average, what you can see is the average data sets. Now, these data sets are all absolute return sets, and I'm going to talk about this here itself. So for the absolute, what you can do is that for, let's say, for an example, for 260, any data point which you choose, like let's say for 21st July 2017 in the graph, which you can see, it has backtested 16.31% return. Now, this particular point just indicates the sum of the previous 260 days daily returns. Similarly, let's talk about 520 here, right? For 520, let's say we consider this data sets. 60.23, which is a percentage, is an absolute return sets for 2 years. It's sum of the previous 520 daily return sets, right? So that's how it works out. Now, if you want to compare all the three periods effectively, then what you can do is you can annualize data sets. Once you analyze the data sets, you can then understand that for a 1 year period since the 2011 to 2023, we're having an average return set from this particular set of an asset of 18.07%. Whereas for a 5 year period, the average return has decreased. You can now see that it is actually 17.7%. But you can also see that the high and the low. Now, what is high and the low? The high and the low signifies the highest return set generated within that period from the period of 2011 to current date 2013, which is effectively 12 years. And you can see the highest return set is basically annualized return set is basically 26.13 for a 5 year period. Whereas you can also see the lowest is actually positive. So if you would have holded such a fund in your portfolio, if you have this fund for a 5 year period, you could have a minimum to minimum low as 4.881%, not in negatives. So that's how you can take a look towards on a basis of rolling return stats, that is it riskier to hold up, for a 1 year period, 2 year period, or is it better to hold for up, 1300 days, which would definitely be beneficial to hold on a longer period run. So if you are, having a conversation with the client, you can use these data sets to determine that how long should I hold such a fund? Is it mandatory to just hold it for 1300 or maybe more than that? Or is it okay to hold it for a 1 year period? And effectively, you can also make a use case study that for a 1 year period, it's quite volatile, because you can see the volatility has actually decreased the more you hold. And you can definitely see between the comparisons between the data sets, the volatility of a 5 year return set, which is a rolling return sets, is actually pretty lower. So to hold such a fund for a longer period is better, and definitely for equities, you should be holding for a longer term period, and you can show it on a factual basis that how it works out when you are comparing the three parameters with the three working periods. right? Now you can change this working period accordingly. I can even change it to 780 and run it, and I get that 1 year, 3 year, and 5 year being compared. And you can also see that it would be better if I could hold for a 3 year period rather than a 5 year period. You can see here the returns, average returns are effectively higher, and also the low is effectively similar to the 1300 days period sets. So that's how rolling return statistics works out. Any particular set of a rolling return statistics which you use currently can be used on a distribution level as well. Now, what is the significance of the distribution? So distribution helps us to determine, let's say we are considering only 260 year. Let's say our use case is only for a 1 year investment within a fund, to understand that what is the probability that I could have a loss. Let's say, I could be going into the loss, portion of the fund if I am unlucky enough, to have that particular set of a loss. So for an example, let's consider this as 0%, right? Now you can now see that let's say we are making a minima as minimum as possible. Let's say we are having a minima as 100, -100. Now what this signifies is that these are return ranges. It shows that between 100% return to 0% return, I would have a probability, which is a distribution of 15.46 percentage. Now, as we calculate the daily data sets from 2011 till the current date, it accurately maps out all the daily return sets and shows that the 15% chance to have certain loss, to have a loss between 0 to 100%, right? And this is where I can then understand that what is my probability of going into such a fund. That there might be some fund that would be truly riskier, that would have a more particular set of distribution between negative return sets. And you can also go ahead and check out, let's say, if there is a client requirement who wants to have return sets between 12% to 25%, not more than that, not less than that. That is what this particular expectation from the client is. But the expectation here is just, you can only expect 30% of the time to backtest between the 12 to 25% from the entire return sets if you are investing 1 year period, right? Let's say we are considering a 3 year period or a 5 year period, right? For a 5 year period, if I'm expecting between 12% to 25, what is my distribution? You can check that here by changing the distribution itself. Now you can now see that there's a huge change now. Now, for an example, if I'm investing for a 1 year period, I had a probability which was just 30%, right? But if I keep being invested in that particular set of fund, there's a 60% probability to backtest between 12 to 25%. And that's the reason holding for such a longer period would be more beneficial by taking a look towards a rolling return distribution and the ranges here itself. So that's how you can use this return ranges for any particular set of a fund or a portfolio in our NGEN Markets terminal. Now here you can change the return ranges here. This is a toggleable button where you can toggle it for a 5 year period to determine the probabilistic view. And what we have given here is the weighted probability return. What it shows is that on this, considering this the fact of the return ranges here, this is what the weighted probability return of backtesting between all of them. You can also see the question mark here. We have given these question marks to assist you whenever you face any difficulties based on any parameters. And what you can do is you can also take a look towards rolling volatility. Now, what is rolling volatility? Rolling volatility is basically the standard deviation calculated from 2011 of our start date till the current date period. So for a current date period, what we have done is that let's consider the rolling volatility only 260. Now, the point here is that you can change this periods here. These are all the working periods here. And then you will also see the rolling volatility based on the periods you have changed. So for an example, if you see the periods here, the 1 year period, how volatile is this fund? If I would definitely want to take a look towards volatility, I cannot just take a look towards only by taking a look towards the fund performance, which is an annualized volatility since 2011. Because volatility is quite dynamic. It might change in certain periods, in certain crises. It might have a huge upturn as well. So what you can do is you can effectively take a look towards rolling volatility here in our system just by taking an average of this volatility. So what is this average? This average is the standard deviation of the 260 data points. So these all data sets which you see are the 260 days volatility. So in one period, you can see in 2016, effectively, the volatility shot up. You can see this is the period which shot up again. And then another period, which was the volatility when it shot up, was the COVID period. You can see it is 2020, effectively Jan. It started in Jan that it became too volatile. And then we had another volatility shot up in September 2022. Now, these kind of, volatility analysis helps us to determine that what is an average volatility which we currently have for a 1 year period, which is actually 14.59%. Now, this volatility is basically for a rolling volatility stats. When you see this volatility as a tab, you should not confuse it with the volatility of the fund, but it is basically the volatility of the volatility. It just helps us to determine that how volatile is this volatility. It's just a standard deviation calculation, or you can say that it is a second level calculation of the standard deviation. And the more volatile it is, so it shows that for a 780-day period, you can now see here, it's the standard deviation of that particular set of the data sets is more volatile accordingly into the system. Whereas you can also see that for a 1 year period, which is 260, the volatility shot up as high as positive 22.81% and as low as positive 9.71%. So the lowest volatility is is positive 9.71%, and you can now compare it accordingly into the system, right? So that's how the volatility works out. And summing up with another parameter, which is called as drawdowns analysis. So I've just given an overview of this rolling analysis. We would be having another session itself for the rolling analysis. But for the point of the risk parameters, you can definitely use rolling analysis with the rolling volatility stats to understand and determine how the volatility has behaved in the last couple of years or the period you've chosen for a particular set of a fund, right? And the last point is to check drawdowns. Now, drawdowns are very useful because, as I've stated before, at Engine we calculate data sets daily, and all the daily computational, calculations helps us to determine what has been the loss, how much loss did the particular set of the fund, has backtested, and what has been the recovery of that loss. Because this will help us to determine the strength of the particular set of a mutual fund or even a portfolio. So for an example, let's take a, one set of a parameter, which is the loss, the highest loss which this fund has occurred is negative 29.44%. Now, the basis of that is that this is a, period which is effectively a COVID period. We had this, it's a, it's a particular set of a risk, idiosyncratic risk. And you can now see that for an example here, that we had the days to recover as 127 days. Now, this is a daily, we consider this as a daily period. And what you can do is you can take a look towards it in a graphical sense as well. So for a graphical sense, what you can effectively do is you can see the graph here. I'm just zooming it in. So to zoom it in, all you need to do is just click on this. And here you can see that the gray area, this gray area is actually denoting the loss period. It started in October 2021, which had the NAV of 73.46%. And effectively, these are all the NAVs. You can take a look towards the data sets here. Now, the main point here is that it has stopped, it's lost, and it started recovering after 21 July 2022. So it had occurred, had a, a huge set of a loss here. This is on a 2022 basis, but you can also see another set of a loss in the COVID period. So COVID period is given here. I'm just zooming it here as well. And you can see that it started in 2020, February effectively, and ended in March, which was effectively, the recovery period starting of all the equities in our universe of Indian domestic mutual funds and even the stocks. And you can now see that this is what the recovery holds. Now, the point here is this, that this is a peak to trough analysis. What we do is normally at Engine, we calculate all the, drawdowns, all the data points on the losses, and then we capture the top 10 drawdowns, top 10 losses. Once we capture the top 10 losses, we then consider it that how many of that losses have actually recovered. So the recovery is actually peak to trough and trough to peak analysis. And it shows that the recovery can be currently here for this particular set of the loss, considering for the fact that this is a COVID loss between, October 2020 or something. And you can effectively see that for a COVID, it was close to September to October recovery date. And you can check the recovery date for any particular set of a loss, which are the top 10 losses in our system. Now, what about the, one which are still ongoing? And we do have current losses which are still ongoing. and this is the one which we can actually consider it, because this is the peak which we had, and now currently our NAV is sitting here with 65.24. You can now see that we have actually not recovered, and there are two losses here. One of them is 2021, which has occurred. It's still 53% recover, and it's still ongoing. Whereas there is another set of a loss, which is a a very current one, which is in 2022 till March 2023, and it is 42% recover. And now it is still ongoing as well. So there are two sets of losses for this particular set of a fund, which is still ongoing and still recovering, right? Now this is how it works out for entire set of analysis, and we can then go ahead with our Q&A session. So I've completed the entire set of a session for analyzing the risk parameters for the mutual funds. So I will start addressing the Q&A. So if you have any questions, you can write it on the chat box or verbally, and we will try to address them. Okay, so there are a couple of questions in the chat box. I will start addressing all those questions here itself. So one of the question was that why confidence margin is set as 95%. So I have previously stated before that when you are considering the confidence margin, which is a confidence interval here in the fund performance, it basically is an industry standard to consider 95% as a confidence interval. Now you can change it to confidence interval of any particular set of a interval. Let's say we can make it 98 or even 99%, and it will show you that particular set of the probability of the loss. Right now, there is a point that you can also go beyond, let's say 60%. Now the point here is that 60% won't make any sense, because there is a 40% chance to have a 0%. That's not how it works out. That is the reason the model sometimes can be broken when you choose to reduce the confidence interval itself. So the point here is that the confidence interval should be between more than 90-95% to understand loss, not not the return sets. So here what you can do is you can put it 90 as well, and you can see that it's 10% chance to have negative 15.65 versus the benchmark. So normally that is how the confidence interval works out for the entire set of any particular set of mutual funds. Yeah, so there's another question, why confidence is not less than 80%. Yes, so that is what the case is, that if you choose to have, let's say, 75%, the entire set of data sets won't make any sense, because there's a 25% chance to have negative 5.92. That won't make much sense, because here what we are trying to achieve is to understand that what is our worst case loss. So for a worst case loss, it's better to have 95% as a confidence interval, and you can see that it can be, there's a 5% chance to have negative 23.04%. So that's the main major confidence interval you can choose. So there's another question. So basically, VAR, value at risk, is used to check the risk with compared to its benchmark. If the VAR for the asset is high with compared to its benchmark, then it is said that the fund is risky to buy. Definitely, it shows what it implies here is that what if the let's consider the benchmark which is not a benchmark of equities, but let's say we are considering a benchmark which can be something like a hybrid ones, right? Now, when you consider this hybrid benchmark, you can now see that, for an example, if a prospective client wants to have lesser losses and is a conservative client, so giving a mutual fund which is only an equity based mutual fund, it's not going to be satisfying the client's purpose of the risk, because here you can see that it's risky to hold this equity asset against a hybrid set of a benchmark, right? So the point is not to compare between the hybrid and an equity benchmark. The point is to display that there is a possible case that one of the equity mutual fund is actually having a negative VAR, which is higher than the benchmark. So here, if you encountered such mutual fund against a benchmark, which is a deemed suitable benchmark, like a mid cap or a a small cap or even a large cap, against that particular set of a fund, then you can effectively determine that it is worth holding that particular set of an asset or not, considering the risk which it implies. So there is another question. Perhaps it is better to compare value at risk for two funds instead of the benchmark. The fund with lower VAR within the same time frame and confidence interval should have lower risk. So fund with negative 2% VAR may be less than risky than one with 5% VAR. Sure. So what we have done is that in our fund section itself, and we are going to be incorporating it in our compare section. But we currently have the first fund section where we have given the minimum historical 95% VAR. Now, considering for the fact that we are considering the funds with similar age period, what you can effectively do is I can effectively take a look towards the small cap funds here and then check out my risk parameters to understand that here in the VAR, which one is actually highly riskier. So you can see that Sundaram ITI PGM is actually having the highest confidence. You can see for the confidence interval of 95%. So there's a 5% chance to have certain losses here, which is negative 33. So comparing it with a DSP small cap, I would be more conservative than considering with a Sundaram small cap. So that's how you can take a look towards VAR itself. And sometimes you can also take a look towards the implied VAR as a comparison for multiple sets of mutual funds in our funds section in a screener itself. And you can also take a look towards that. I would like to know the VAR which is at least having negative 30. I would not like to go beyond negative 30. So you can just type in negative 30. You can now see that these two funds will be gone. So if I apply this up, the two funds will be gone, and you can now see that only Aditya Birla SL is actually the highest negative VAR, uh, negatively historically VAR backtested. Okay, there's another question which is, can we calculate drawdowns for index? Yes, sir, we can. What you can do is you can go to the compare section, as index is where you need to compare it effectively with other set of parameters. So I'm just gonna show this up to you. We have actually done this in our previous session as well. What you can do is you can add in as many index as you want. So let's say I'm adding Nifty TRI here. So 500 TRI versus, let's say I'm comparing Nifty TRI, which is Nifty 50 TRI. So what you can do is you can effectively add as many index here. And once you compare it up, what you can do is you can go to the drawdown tab here itself. Now, what I'm doing here is, let's say I'm just removing this fund in from the compare section, and you can now see the drawdowns. Now here in this case, due to the limited set of a higher data sets here, what you can do is you can do the top 5 drawdowns for index. Now, it can be compared with a mutual fund. It can be compared with a particular set of a stock if you want to do, and you can now see the entire drawdowns for for a particular set of an index uh, comparatively into the system, which shows the recovery and everything in one single go. And we'll then talk about the top 5 drawdowns. So in this case, you can see that this is actually the dot-com bubble when the Nifty 500 had a loss of negative 67, and it recovered in 500 days, close to 500, 570 days. Okay, there's a question called, will you please explain drawdowns again? Okay, so I'm just gonna open up a drawdown section for any particular set of a fund to give you a proper set of analysis. So 1 second. So here, drawdowns, what you can do is that drawdown is just a peak to trough analysis for the NAVs. So here, when you see this data sets, all the gray areas which you see are the top 10 drawdowns, which are called as losses. Now, these losses which you see here, let's say we are considering the COVID period. So here, when you zoom in, you see that this is the peak of that particular set of a period for the NAV, and it had a fall after a couple of days or a couple of weeks. And you can now see that after that it started recovering. So the drawdowns analysis helps us to understand that what has been the loss, how much loss it has occurred, within the start and end date. You can see the loss has been actually negative 29.44 for this period. The start date of the loss is 20th Feb 2020. The start price was similarly 42.76, close to here. And the end price of that particular set of a loss was effectively 30.17, right? And once you see this, this is the end price, and then how many days it took to recover. Now the recovery starts from this white area because this was a drawdown period, and the recovery will show you that it is now the uh, trough peak analysis where it will then calculate the number of days to effectively come to the point of 42.76 again, which will then record as a recovery. So the recovery again, so you can effectively say that the NAV had a fall of 29.44% in that particular set of a period, and it took 127 day to come back to that particular set of start price in the recovery session. So that's how we calculate the drawdowns in our system. Now, what we do is at Engine, we calculate as many drawdowns as possible. But for a display purpose, we are displaying the top 10 ones to actually give you an analysis. Like for an example, if I consider a small set of a drawdown, even this can be considered a drawdown. If I just say for a 1 day period, I can say that from 09 December to 2020 to this particular set of a day, which is a 10th December, within a day it had a fall. Yeah, it definitely had a fall, but it is a very minimal drawdown, which is not so intuitive when you're comparing and coming up with decision making for a fund. So that's the reason we are calculating the top 10 drawdown. And you can also see that it recovered within 2 days. So it does not make sense to make a drawdown for a 1 day and then show the recovery of 2 days. So that's how this works out for the drawdowns analysis for any particular set of a fund. There is another set of question called, can we see capture ratios in the compare section also? Okay, so for this question, sir, we have actually noted this down already from our engine team, that we will now be adding capture ratios in our relative column, which is called as this column. Now, this is in current development, so our product team will definitely send you a mail or will give you an update through Twitter as well once it is loaded in our system. So currently, what you can do is you can check out the capture ratios for funds individually or even for a portfolio. But here, what you can do is within a few weeks or so, we will then be updating it. The timeline will be updated soon enough. So we will then be, updating the capture ratios in our relative columns. Okay, there's another question. Can you please explain rolling returns once again? I'm just gonna give you the brief of rolling returns. So let's take a look towards rolling returns here itself. I will just remove one of the index here to give you an analysis for rolling returns on an index level. So here the rolling returns. We what we effectively do is I'm just gonna choose sample returns, and so let's take a look towards from, let's say, 2000. So it is effectively 23 years. Now, what we have done here is that any data point which you see here shows you the sum of the previous 260 days daily returns. Any data points. You can even go ahead and choose another data point of 2018. So had I invested 260 days prior to 2018, I would have had a return sets of 17.80% for a 260 days. Now, what we are trying to achieve here is to show you that what has been the simulation if you start investing every single day since 2000 to 2023, what is an average return sets that can be generated, right? So that is where you can actually see that this is the average of all the rolling data points in our system. The better the average is, the more it is that we are having a best average return sets. And similarly for the positive percentage as well, which you see here, it shows us that there's a 78% of the distribution positively backtested more than 0%. So you can now determine between the comparisons of the indices. Let's compare it in the index level as well. That if we are comparing it on all index, just a second, I'm just gonna add index. So if you want to add index from any particular set of stock or mutual fund, or if you want to add it, you can save it here in the system. And I am loading the world markets here to give you an active comparison. And once you do the rolling analysis, you'll see the average for a 260-day with a simple return statistic. And it now shows for an inference that S&P BSE Sensex is actually having the best average out of all the indices in the world right now, right? And you can also compare between the indices to show that what has been the best positively backtested index here. So in this particular set of a scenario, there's a 76% of the entire distribution is in positive return sets. So if I just blindly invest, go ahead with this particular set of a portfolio, 76% of the time it has been backtesting positively. So that's how the rolling returns works out. We will be having another session on rolling analysis itself, truly concentrated on the entire tool. But if you really want to check out rolling analysis, we have the videos tab here. It will, because I've just given a brief here, so what you do is you can just search out our videos. We have given a playlist here where we have effectively targeted only rolling analysis in our webinar. So you can check out the webinars for rolling analysis. It has given all the calculations as well. It will help you to determine and understand the tool effectively. There's another question: explain the difference between historical and implied value at risk. So I'll just give you a brief explanation here. Here, what you can do is you can effectively see that historical and implied. I'm just going to show it in an Excel because for an Excel, what it does is that when we calculate the historical VAR here, it shows it takes into consideration the daily return sets. So I've highlighted this. You can see that these are the daily return sets. Consider considering the confidence interval, which is currently now 88% with a probability of 12%, right? Whereas when you go back to the implied is specifically the parameter which considers the standard deviation. You can see we have considered the standard deviation of these daily return sets. And then we have actually normalized it with an inverse with the function here to get the probability. The probability here is 12% as well. So in this case, let's say if I consider the worst case scenario, 99, or you can even go beyond in Excel 99.99, right? You can now see that I can have a huge set of a loss which can be negative 159. Now this is pretty not realistic here as well. But what you can do is you can effectively change the confidence interval accordingly into the system. At engine, what we have given is 99% only. So for a 1% probability, you could have such a loss, and it looks realistic on a 1% probabilistic sense that on a loss making sense that on a basis of volatility, we are actually having, we might have lesser losses, but on the basis of only considering the daily return sets, we might have loss, more than we have actually thought of. So that's basically it. This just shows you the probability. These are not accurate losses, first of all. It's a probabilistic value model for the historical implied. So you can use this model to actually compare it with proper set of intervals. So if you're comparing between the two funds with two side-by-side analytics, I would recommend you to keep confidence intervals same so that the comparison is actually accurate. So there's another question, what main parameters to check to screen best funds? There are ratios, many ratios, returns analysis, and many other things, main points to look for research. So there are definitely a lot of parameters at Engine where you can take a look towards by, coming up and screening up with the mutual funds. As we have talked about value at risk, so I'm just going to talk about value at risk itself. That let's say you're considering for the fact that you're screening mutual funds only 4 or 5 categories. So let's say we are considering multi-cap, mid-cap, large cap, and flexi-cap and focused. So I would like to have my these set of categories on the basis of value at risk itself. So what I can do is I can choose in, let's say, negative 27. Now this is the 5% this is the 5% probability to have certain loss. And I would not like to go beyond this negative 27. So I can just apply it up. You can now see that these are the funds which have actually backtested, right? Now you can also put in a Sharpe ratio like 0.50. Now this depends upon what would you like to have. You can now see that only these funds fits my criteria. right? Now, what if I change my value at risk? What if I would like to have lesser losses? I would like to be more conservative on my own demand. So what you can do is you can now see that there are only these six funds which actually has a better Sharpe ratio and this value at risk. Now, if it does not satisfy you, what you can do is effectively, as you know, hybrid funds would be better into conservative domain. If I choose in a dynamic asset allocation, you will now see those a couple of balance advantage fund being backtested, right? So that's the point here, that you can choose as many of the funds here. Once you choose in the funds, let's say here, if we have given in, then you can now see that these are the funds which actually fits the criteria based on the Sharpe's ratio. So you can choose a Sharpe's ratio of 0.40 and apply it up. Now see, these are the funds which actually fits your criteria, including the hybrids and even the equity based funds. So that's how you can screen it up. And there are other parameters as well, like rolling analysis, risk versus return, and position overlap. Because at the end of the day, you would be then converting those funds into the portfolios itself. So you can then explore those data sets. For the question you have is, we have also given on the videos tab a screening mutual fund to generate model portfolios. So here in the here in this particular set of a video, which was just 3 weeks before, you can actually review this video as well, because this video will give you all the specific screening parameters to come up with model portfolios as conservative, hybrids, or any particular set of a portfolio. So I would recommend you to view this video, which is just 4 weeks before, and you can then take out accordingly. There's another question, sir, how to download data sets for from engine for index currency for daily checking daily, monthly, and yearly return. So what you can do is, you can download the data sets for index here as well. I mean, daily, monthly, yearly return sets. As you can see, these are the data sets which have already been generated. And to download them, there are certain ways. One can be to actually print a PowerPoint report. Another way is to actually export the data set. So for the question you had, what you can do is you can uh, export result in CSV, which will effectively solve your question. So here you can take out these data sets based on 1 day till 1 year. So these are the data sets which you can compare for index or even for a fund. So you can compare the funds and then download the data sets here itself. So there's another question: can we get schemes invested in foreign equities? Um, as of now, we have holdings analysis. We need to check it out if we can get it. So within holdings analysis, what you can do is you can effectively go to the fund section, and in holdings analysis, we have given this uh, sector changes. Now, the point here is that you can filter the holdings type here as foreign equity. So we need to check out, yeah, yes. So you can now click on it, and you can now see the funds which have invested in the foreign equities. So here is that you can take a look towards it in the consideration. What you need to do is you can go to the holdings analysis tab, sector changes, and within sector changes, you can click on this filter holdings type. Once you click on it, instead of selecting, normally what we do is we select equities, and you can now see all the sectors here. But instead of that, you can now see the foreign equity or even foreign mutual fund, right? Once you select those two, and once you cancel it out, you can now see the percentage allocation and value invested in crores. And once you click on it, so definitely you would like to check out for 31st March 2023. You can click on this, and you can now see the percentage allocation and even the amount. So effectively, yes, Parag Parikh Flexi Cap is having 17% in foreign equity, and that's how you can check all the 41 schemes. So it's not just for the ETFs or any other schemes, but you can also check out for regular mutual funds like FlexiCap, like SBI FlexiCap is currently having 3% of foreign equity exposure. And if you want to go beyond this, what you need to do is just click on it. On the name of the fund, you can now explore that fund based on asset allocation. You can now see that there is a 3% allocation to Microsoft and Alphabet in SBI FlexiCap, which accounts for close to 3.79%. So this is the process you can follow to find foreign equity for the schemes in our system. And you can effectively check it out for other categories as well. Let's say hybrid one, if there is any holdings based on the hybrid, if they currently hold the foreign equities or not. So are there any other questions? Sure. So if there isn't any question, I would request everyone that we can then close our session for today. We will come up again in the next week with certain different topic based on your own recommendation, and then we can definitely address all the questions itself for you guys. So thank you so much, everyone, and have a nice weekend ahead. Before closing the session, I would recommend you to take a look towards our updates tab. These are the updates which we are currently onboarding. There are some insights, there are some other updates as well, and also the engine updates which we are giving it through the Twitter. And also, if you want to take a look towards the videos I've already narrated it before, what you can do is you can head towards the video or even search engine markets. And another important thing is that if you have specific questions, my recommendation would be to check out engine shorts, because it shows you the comparisons of the market levels. As the question was how to compare market levels across several indices, you can easily take a look towards it, and it just takes 40 to 50 seconds to solve that query. So there are more than 100 shorts we have added for your own conveniences. So you can take a look towards it. If you have any questions, you can always write us on support@engineresearch.com. So I'm just writing this mail so that if you have any queries, any doubts, you can always write us towards this mail ID. So this is this is the mail ID, which is support@engine.com. And going ahead in stocks, I think there is another question which we had in stocks analysis. Can we see the number of funds hold that particular set of a stock? Okay, so what you can do, sir, is I'm just gonna, address this question here itself. You can go ahead with the equity holdings here, and you can search that stock. So, for an example, if I want to know Adani Green, right? So you can search Adani Green, and you can see that these are number of funds, which are 34 funds, which can include ETFs as well, uh, which is holding Adani Green. So that's the answer for your question, sir. So thank you so much, everyone. If you have any doubts, you can always write us on support. If any questions have been missed out, you can write us on support and we will try to address them. Or next week, we will definitely be addressing them itself. So thank you, everyone. Have a nice weekend ahead. Thanks.